without further ado, we're talking about a main topic here that I think should be pretty exciting for everybody regarding markets and exchanges. Herwig, we'd love to hear your breakdown of what we're talking about.
It's actually by popular request. So let's get into this because this is often what's considered the sexy part of tokenization, the trading and liquidity. And both investors and issuers alike typically ask the same thing once they grasp the technology of tokenization, which is where can I trade them? And this is a major challenge for the industry since many exchange and trading venues dedicated to providing liquidity have not yet even gone live, with less than a dozen dedicated players today trading fewer than a dozen tokens, making it, of course, all very difficult to simply point to a platform like T0 or FN and say, this is where you can do it, and many people do it anyway. We always recommend also pointing people to our list of over 60 exchanges and markets that are launching over the next couple of years that you can find on our blog. And as consultants, we have conversations with issuers and investors all the time, and the reality typically comes down to forming out a well thought out liquidity strategy. Tie that in with a lockup period for many STOs, and many issuers end up feeling comfortable that eventually their tokens will find venues for liquidity because of the technology. Back in the beginning of 2019, I laid out an article to address the very problem of peddling liquidity from industry supporters because we didn't technically have any yet, and there's a very big difference between liquidity and access. And through this article, I did lay out some of the strategies that we're going to talk about today. So, the first thing to remember is that the issuer as an entity can also help facilitate secondary transactions, and many technology providers offer white label exchange solutions or marketplace solutions to power a private market. An issuer can control their own market by simply managing it through a combination of buyback programs, redemption periods, and outside financial partners such as market makers. They can now create liquidity for their token and have a lot of control over the market and the whitelist of investors able to participate in it. This is also often attractive from an investor relations perspective because investors would need to interact directly with the issuer, making things like disclosures and governance easier, but also useful for future fundraisers and issuances for the investor to potentially participate in. Now, I believe, especially in 2020, but well beyond, that we are going to see many issuer-managed markets as sort of the first way for a lot of STOs to provide liquidity. But the beautiful thing about security tokens is that they are distributed digitally, and marketplaces of all sorts can compete to provide liquidity for them. We've seen examples of peer-to-peer marketplaces arise. These are essentially technology providers aiming to provide all the tools needed to help a buyer and seller find each other and transact with each other directly. From a decentralization perspective, this is great, but from a regulatory perspective, let's just say it's complicated. We saw back in the day that blockchain capital tokens in its originally issued form were trading on a decentralized exchange called Ether Delta. Well, due to the fact that these were actually securities being traded, many security regulations were actually violated because on this platform, there was no way to know who the purchaser was. There were certainly no checks of their eligibility, whether they qualified to make the purchase. And as a result, BCAP had to go back and redeem and qualify all token holders, and that's, I believe, when they switched over to Securitize and did a reissuance of the BCAP token, which now is the one trading on OFN today. So peer-to-peer exchanges are possible, but they need to have the right controls and potential licenses in place to fully pass as a peer-to-peer transaction compliant with the law. That's why sort of the next step up in liquidity providers we see is financial institutions, broker-dealers and investment banks that are governed by FINRA and regulated by the SEC to ensure protection for investors and fair markets, and therefore are designated to offer brokering activities and solicit STOs on the behalf of an issuer or seller. They typically manage a network of investors, and of course now in the digital age can offer an E-Trade-like experience to buy into these private investment opportunities. Specifically in the US, the term would be a broker-dealer with an ATS license or an alternative trading system license, which gives them the ability to facilitate these secondary transactions. The current live examples of this are Open Finance Network and Dinosaur, which is powered by T0, but T0 has announced that they themselves will also have the T0 ATS that they will primarily use in the future. These players are all operating under that same license to offer digital trading platform options. But every single one of those names I just mentioned, not a single one of them is actually a nationally licensed exchange in the US. When I say that, we are talking about an exchange like the NASDAQ or the New York Stock Exchange. All those other players are actually trading venues or marketplaces. We also do see the emergence of international regulated exchanges like Merge in Seychelles or Tokenize in Barbados, or many of the various national exchanges that have teamed up with BlockStation in the Caribbean. But in the US, there is only one national exchange that's not even live yet, not even approved yet, focused on the support for security tokens, which is the Boston Security Token Exchange that we mentioned earlier, which is, of course, a 50-50 joint venture between Box and T0. It's not certain, how much security tokens or how that's going to be as a part of their strategy, since they also intend to offer the traditional way. But it sounds like it'll be very similar from an IPO perspective. And therefore, right now, the U.S. still, despite not having approval, does not really have any national exchanges dedicated to security tokens. And even still, as T0 had mentioned in the past, the BTSX is designed to be for the next step up of issuers. On the other hand, we, of course, have T0 and Open Finance and many others that will are more looking like to become the, quote, future NASDAQs or New York Stock Exchanges of the private market, if you will. So there you have it. That's pretty much the range of the different liquidity methods for security tokens. I wonder how many people didn't know that T0FN were, in fact, not exchanges, but actually simply just marketplaces trading under, with the right licenses. But hopefully people found it helpful.
It's a great breakdown, Herwig, and we've seen many peer-to-peer swap solutions pop up over the last couple of years between atomic swaps and P2P platforms and many of these other things. But ultimately, they haven't yet been able to scale to the volume that we've seen from live ATSs. And potentially, these ATSs themselves may face the same scaling limitations compared to the future licensed exchanges. So these options are suitable for the smaller levels of volume, these options being the ATSs and some of the swappings that we've seen already. But we definitely expect to see dozens of additional marketplaces and liquidity options springing up in the coming 12 to 18 months, which will help with that liquidity, right? You may have specific marketplaces or trading platforms that provide liquidity for real estate or for debt instruments or for equities or for whatever. Maybe it's jurisdictionally based, maybe it's industry based. We're not sure, but those kinds of solutions may help with that additional liquidity for maybe a more focused pool of interested investors or whatever.
Fully agree with that, Kyle. I see the future perhaps not more focused on just a specific few venues, but perhaps a lot of different scattered and fragmented venues. And there's definitely a good point around international arbitrage, if you will, for the international exchanges to potentially capture some of these U.S. private assets to go public on their exchanges as opposed to here in the U.S. because they have more efficient tokenized options available.
And if you're ever not sure, if you're looking for a way to distinguish between some of these things, definitely pay attention to the word exchange. Sometimes we use it colloquially here on the show, and certainly it's pretty popular around the cyberspace to mention anything as an exchange. But certainly, at least here in the US, if you're an ATS or a marketplace, you have to be very strict about not using the words exchange because historically the SEC and other regulatory bodies have looked down upon that for firms that use that term exchange without being a nationally licensed exchange. So definitely try to keep your terminology straight. If you look at a T0 or Open Finance, you'll see no mention of the word exchange. They use marketplace, they use trading platform, many of these other terminologies that kind of help suggest that they're more ATSs. Once you see exchanges go live, they will not hesitate to use that language. So that's definitely an interesting distinction to make.
In fact, the BTSX has it in their name. And with that, as always, thanks again for listening. We hope to catch you next week. And please send us your feedback. We always want to try to improve the show. You can reach out to us on our socials. We're on Twitter. We're on LinkedIn. We're everywhere. But as always, thanks for your support.
Talk to you next time.